Ever thought about those elevators, the escalators you use pretty much every day? They're kind of the unsung heroes of our cities, aren't they?
Absolutely. Just silently moving millions.
Exactly. And a global giant like Otis Worldwide Corporation, they're behind so much of that. So today, we're going deep. We're taking a close look at Otis's second quarter 2025 earnings.
Right. And our mission here really is to get beyond the headlines. We want to unpack what Otis's latest reports really tell us about how they're doing, how they're adapting strategically.
And where they might be headed.
Yeah, exactly. Because it's a complex global market out there. And what's fascinating, I think, is seeing how a company like this, so tied into urban mobility, navigates all the challenges, but also the opportunities.
So think of this as your shortcut, really. We've waded through the earnings call, the SEC filings, all of it.
Pulled out the key stuff.
Pulled out the key stuff, and we're ready to break it down for you.
Okay, let's do it.
All right, so let's start with the top level numbers. Q2, first half of 2025 for Otis. Overall, they reported solid results.
Solid, yeah.
Yeah. Net sales for Q2, $3.6 billion, pretty much flat compared to last year. For the whole first half, $6.9 billion, which is just a slight dip, like 1%.
Okay. And organic sales.
Right. Organic sales, taking out currency swings and acquisitions, they were down 2% in Q2 and 1% for the first half.
Mm.
Adjusted earnings per share, EPS, that saw a 1% dip in Q2 down to $1.05. But interestingly, for the first half, it actually grew 2%, reaching $1.97.
So a bit of a mixed bag right off the bat.
Yeah, exactly. So what does it all mean? You've got these kind of mixed signals, which really sets up this tale of two segments within Otis.
It really does. And that takes us straight to what you could call Otis's bedrock,
Yeah.
the service segment.
Their foundation.
Unshakable foundation, really. I mean,
Wow.
this isn't just a good performer, it's the main engine. It makes up something like 90% of their total operating profit. 90%.
Wow. Okay, so almost all the profit comes from service.
Pretty much. And when you look at growth and scale, it's just remarkably consistent. Organic service sales, they grew 4% in Q2.
4%.
Yep. And that growth was positive across all their business lines and in every region globally.
That's impressive consistency.
It is. And their maintenance portfolio, which, by the way, is already the biggest in the industry, it grew another 4% this quarter. They're now servicing 2.4 million units.
2.4 million elevators and escalators.
Yeah, it's huge. And here's something interesting. The repair business really picked up steam. It grew 6% organically in Q2.
6%. Wasn't it much lower before?
Yeah, it was only 1% in Q1.
Mhm.
So that's a significant jump. Plus, the repair backlog is up 8%. That sets them up really nicely for the second half of the year.
Okay. And modernization, how's that looking?
Also strong momentum there. Orders for modernization accelerated, grew 22%. That pushed the backlog up 16%. Constant currency.
16% backlog growth, stripping out currency effects.
Right. Gives you a clear picture. And Otis thinks modernization sales will grow around 10% for the full year.
Okay, so service is growing, repairs accelerating, modernization strong. What about the profitability side?
Well, that's maybe the biggest highlight. The service segment hit a record operating profit margin, 24.9% in Q2.
A record since they spun off.
Yep, the highest since the spinoff.
Yeah.
And get this, it's the 21st consecutive quarter of operating profit growth in service.
21 quarters straight. That's stability.
That's the service flywheel effect we talked about. It's like their strategic superpower. You have this huge installed base, right? It just keeps growing, expected mid-single digits this year.
Yeah.
And that base provides this built-in engine for more maintenance contracts, more repairs, more modernization, predictable, high-margin revenue.
It really cushions them, doesn't it?
Hugely, especially when new construction slows down. It gives them this resilience. It's a real competitive advantage.
Okay, so can you give us some examples? Make it a bit more concrete.
Sure. Let's look at some project wins. In the Americas, Indianapolis, they're modernizing 21 elevators at the One America Tower. New controls, doors, the works. And that relationship goes way back to the 80s.
Building on long-term ties.
Exactly.
Yeah.
Then over in the Middle East, Dubai, they landed a deal for 20 skyrise elevators at Damac Day 2. That brings their total with that developer, Damac Properties, to 88 elevators across 6 towers.
Big projects.
Yeah. Oh, in China, despite other issues we'll get to, they still won contracts for over 400 escalators and connected elevators for metro and infrastructure projects in big cities. Hangzhou, Chongqing, Tianjin.
Still winning infrastructure deals there.
Right, and Asia-Pacific Ho Chi Minh City in Vietnam. Otis got picked to install and maintain elevators, including their Skyrise and Gen 3 systems, at a big 39-story mixed-use place called The Cross. And they're integrating their smart management systems too, Compass 360 and EMS Panorama.
Hearing these examples, it really hits home. These aren't just numbers on a page. They were literally the systems keeping these vertical cities running. What really strikes you about the scale and just the steadiness of the service business? It's the core, right?
It absolutely is the core. And I think what people sometimes miss is just how vital that predictable high-margin revenue is, especially, like you said, when other parts of the economy get choppy. It speaks volumes about their customer relationships and just the basic need to keep the stuff running safely.
Absolutely. And having that strong core lets them handle bumps elsewhere. Which brings us to the other side of the core.
The new equipment segment.
Yeah, the new equipment segment definitely faced more headwinds in Q2. Organic sales there dropped 11% in the quarter.
11%.
Ouch! And 9% for the first half. Globally, new equipment orders were down 1%.
Just 1% overall, but sales were down much more.
Yeah, which suggests maybe timing, backlog conversion issues, but the big story here, the main drag, was definitely China.
Right, China.
Orders in China just tanked, down more than 20%. Sales also down over 20%. And they put it down to, the soft market there continuing. Plus, they're being really strict on credit before they ship anything.
So managing risk there carefully.
Seems like it. And their outlook for the China new equipment market, they now think it'll be down about 10% for the rest of 2025.
Still a tough market.
Very. But here's the flip side, the counter trend. If you take China out of the equation...
The ex-China view.
Exactly. New equipment orders outside China actually jumped, a really strong 11% year over year.
11% growth ex-China. Okay, that's significant.
Yeah. The Americas region saw orders up in the low teens. That's the fourth quarter in a row. North America specifically was up 15%.
Strong in North America, then.
It's very.
Yeah.
Asia Pacific also delivered strong results, order growth over 20% for the third quarter straight, mainly led by Southeast Asia and India.
Southeast Asia and India are bright spots.
Definitely. And EMEA, Europe, Middle East, Africa sales there grew 7% in Q2, and that was really driven by the Middle East, which saw growth over 20%.
Oh, Middle East is really booming for them.
Seems that way. Now, looking at the backlog, the total combined backlog for Otis, service, and new equipment was basically flat compared to last year. But again, if you strip out China...
Let me guess, it looks better.
It increased a solid 10%.
10% growth in the backlog ex-China.
Yep. And similarly, just the new equipment backlog globally was down 3% at constant currency, but take out China, and it grew 8%.
Okay, so the picture outside China is actually pretty healthy on the new equipment side, despite the overall decline.
It is, although we should mention they did note some continued uncertainty around global trade policies, causing some project delays in the U.S., so not entirely smooth sailing even there.
Right, which really brings up a key strategic question, doesn't it? When you've got such a major headwind in one huge market like China, how do you pivot? How do you leverage those strengths elsewhere, like they seem to be doing, to keep the whole ship stable?
Exactly.
I mean, that performance outside China is impressive adaptability. But is there any risk, maybe long-term, in relying so much on diversifying away from China? Or is that just pure strength?
That's a great question. I mean, clearly having that strength elsewhere is critical right now. It's acting like a shock absorber. But, you could argue it might be masking a deeper issue in China that maybe needs a more fundamental fix eventually.
Possibly.
It shows the power of being truly global, right?
Yeah.
Hedging your bets. But it also means you have to be incredibly agile, constantly managing those different market dynamics.
For sure.
And that kind of leads us perfectly into what Otis is actually doing about all this. They're not just sitting back. They've got strategic initiatives underway.
Right, they're being proactive.
First up is their Uplift program. Can you tell us a bit about that?
Yeah, Uplift is basically a big internal transformation program. They're trying to standardize how they do things, improve processes, get smarter about supply chain procurement, really streamline the whole operation.
And how's that going?
They say it's on track. They're aiming for $200 million in run rate savings by the end of 2025.
Run rate savings. That's like $200 million less cost every year going forward once it's fully baked in.
Yeah. Exactly. Permanent savings. And for this year, 2025, they're targeting $70 million of those savings.
Okay, substantial. And then there's the China-specific stuff.
Right, the China transformation.
Yeah.
Given how weak that market still is, they're taking extra steps there to cut costs.
More cost-cutting in China.
Yeah. They now expect to get $40 million in run rate savings from that transformation by year-end 2025, with $20 million hitting this year. And remember, this includes that big organizational shakeup they announced back in January, really trying to optimize how they approach the Chinese market now.
So specific actions for a specific problem area. Makes sense.
It does.
And what about tariffs? That was a worry earlier.
Yeah, there's actually some good news there. The hit from 2025 tariffs, they now expect it to be roughly half what they initially feared.
Half. Okay, why the improvement?
Seems like it's down to more favorable reciprocal tariff rates coming through, plus their own efforts to mitigate the impact. So instead of a bigger hit, they're now looking at maybe $25 million to $35 million impact for the year.
And mostly in the second half.
Mostly in the second half, yeah.
So cost savings programs, China restructuring, tariff mitigation.
What's really interesting here, I think, is how proactive they're being. It's not just reacting, right? They're making these pretty significant internal changes to try and build more resilience, more long-term competitiveness.
These aren't just quick fixes.
No, they seem like foundational shifts aimed at permanent efficiency gains, regardless of what the market does next quarter.
Okay, so let's shift gears a bit. Let's talk financial outlook, shareholder value. How are they projecting things forward?
Well, despite those challenges in new equipment we talked about, especially the lower profit expected there,
Yeah.
their overall outlook for adjusted operating profit remains unchanged. They're still guiding for $2.4 billion to $2.5 billion.
Holding steady on profit guidance, what does that tell you?
It tells me a lot about their confidence in the service segment's strength. It's clearly doing the heavy lifting and shoring up the bottom line, enough to offset the weakness elsewhere.
So service is the safety net.
A very strong safety net. And similarly, the adjusted EPS outlook for the full year, they reconfirm that too. Still expecting $4 to $4.10 per share.
Which is what, 4 to 7% growth over last year?
Yep, 4 to 7% growth.
Okay. And cash flow, returning value to shareholders.
Also looking pretty solid. Adjusted free cash flow is expected between $1.4 billion and $1.5 billion for the year.
That's a good chunk of cash.
It is. And they're on track to return $800 million to shareholders this year through dividends and buybacks. They've already done about $550 million in share repurchases through June.
Busy buying back stock.
Yeah, and remember, they approved that new $2 billion share repurchase program back in January, so they've got plenty of firepower there if they choose to use it.
Right. So strong cash flow, returning capital. What about their view on the overall market now?
Their view on the global new equipment market hasn't changed much. Still expected to decline mid-single digits in 2025 overall.
And regionally.
Regionally, they see the Americas down low single digits, but they did mention improving trends there. EMEA, they expect low single-digit growth. And Asia, well, that's still projected for a high single-digit decline overall.
Driven by
China's expected low teens decline, which kind of overshadows the mid-single-digit growth they expect in the rest of Asia Pacific.
Okay, so connecting all that back, the fact that they can reaffirm their profit and EPS outlook despite those new equipment headwinds, it really underlines that stability story, doesn't it?
Yeah.
The service model provides a buffer.
A powerful buffer, absolutely. It really insulates them from the full brunt of those fluctuations in new installations globally. It's the core strength shining through in the numbers.
Yeah, definitely. And, as we sort of wrap up the financial side, it's important to remember it's not just about the numbers, right? There are broader things that speak to a company's long-term health.
Totally agree. Like their focus on sustainability and corporate responsibility.
Exactly. They put out their Connect and Thrive report back in June. It details their progress on things like health and safety, governance, environmental impact, people, all tied back to their core values: safety, ethics, quality.
And they've been getting some recognition for it too, haven't they?
They have. Named one of America's climate leaders by USA Today's Statista and net zero leader by Forbes, highlighted by Newsweek for environmental sustainability.
And Time Magazine again.
And Time Magazine included them in the world's most sustainable companies list for the second year running. So clearly making strides there, or at least getting noticed for it.
That's good to see. What about other non-operational stuff? Any legal or financial updates?
Actually, yes, there was a pretty significant and positive ruling on that German tax litigation thing dating back to August 2024.
Ah, the tax case. What happened?
They won. It looks like they're expecting total refunds of around 307 million net of tax.
307 million euros. Wow.
Yeah, that's about, 355 million US dollars as of June 30th. It's complex, involves their old parent company, RTX, but the bottom line is it's a nice chunk of cash coming back to them.
Unexpected windfall, basically.
Pretty much. Gives them even more financial flexibility. And
Wow.
one other thing, they're clearly investing in leadership, too.
How so?
Well, they appointed Joseph Armas as the new president for Otis US and Canada back in May. And they disclosed his compensation package, which kind of shows how they attract and keep top talent. We're talking a solid base salary, significant short-term incentive targets, plus a large long-term incentive award, mostly stock units tied to performance.
Aligning executive pay with company success.
Exactly. Plus the usual executive perks. It just paints a picture of a company investing in its people at the top. So yeah, putting it all together. It really drives home that success isn't just sales figures, is it? It's also about sustainability, people, handling complex legal stuff.
It's the whole package.
Yep.
So if we were to sort of sum up Q2 for Otis,
How would you frame it?
I'd say the results really show a company that's firmly anchored by that super resilient, highly profitable service segment.
Yeah.
And they're using that anchor to strategically navigate the choppy waters in the new equipment market, especially in China, while at the same time keeping a clear focus on returning value to shareholders and, investing in their future.
That sums it up nicely. So next time you're stepping into an elevator, riding an escalator, maybe think about the complex global machine behind it.
The strategic calls being made.
The strategic calls, yeah, and this deep dive we just took into how Otis keeps it all moving. And maybe here's a final thought for you to chew on. How could that idea, that service flywheel, where your existing customers just keep generating predictable, high-margin cash, how could that concept change how you think about stability and growth in any industry facing these kinds of dynamic shifts?
Interesting question to ponder.